When we purchase a home, a lot of times we look at the purchase price and the first thing we want to negotiate is, I don't want to pay that much. I need to get a reduction on my house. So we write up the offer and we say, hey, instead of paying X on this house, we want to discount the house by $10,000. Well, I wanted to come on here and tell you there is another alternative to discounting the purchase price. And right now, with their interest rates being as high as they are, this alternative is actually more advantageous for you than getting a discount on the house. Let me explain. There is what's called a buy-down credit. What is a buy-down credit? Basically, this is an agreement that you make with the loan officer or whichever bank, the lender that you choose to finance your loan. They will take 1% of the loan and they will buy down the interest rate 0.25%. That is called a point. To give you an example, for easy numbers, if you had a $100,000 loan, you could take $1,000 and discount your interest rate 0.25% for every $1,000 that you pay. Why is this important? With the interest rates being as high as they are, it can save you significant amounts of money on the interest that you pay onto the loan, and it could actually lower your monthly payment more than if you just had a regular discount off of the purchase price. Let me give you an example. Let's say we're looking at a house and the purchase asking price is $300,000. That's what the seller wants. But we don't agree. We think, hey, the market's not showing that. Houses around here are selling for $10,000 less. And so we want to offer $290,000. Well, at 30 years, roughly 7% interest, our payment on that would come out to be $1,930 roughly. Now that is not taken into an account that there are taxes and insurance that is escrowed into that payment. So this is just strictly the loan payment, but I want to do it this way to show you the difference on the payment. So they dropped the price for us, they agree, congratulations, we're now paying a $1,930 a month payment. What would option 2 look like if instead of asking for them to discount the price $10,000, they agreed to give us a buy-down credit of $10,000? Here's how that would look. Instead of paying $290,000 for the house, we're actually going to pay $300,000 for the house. $10,000 being applied as a credit to buy down the interest rate that actually knocks off 0.83% of that 7%. So now, instead of financing a $290,000 house for 30 years at 7%, we're going to finance a $300,000 house for 30 years at 6.17%. Pretty significant difference. What's that look like on the payment? Your new payment, instead of the $1,930 a month, is now $1,830 a month, give or take a couple of dollars here or there. So you're roughly saving $100 a month on your note by getting a discount on your interest rate versus getting $10,000 knocked off the loan. But that's not the biggest part. The most interesting piece of this is over the term of the loan, the 30 years, if nothing ever changes and you pay your note out every month as you're supposed to and you never refinance, that will save you over $30,000 in interest on the total price of your house. So next time you're looking for a house or next time we're shopping for something, we'll talk about that. Do you want to knock the price down? Or do you want to take that same amount and ask for a buy-down credit? I hope that was informational to you. Give me a call. We can talk about it more. If you're ready to buy or sell, I'd like to show you that strategy. I've got a spreadsheet that will actually break it down and compare it for you. So when we get ready to make an offer, we can make sure that you are getting the best deal and that you're going to have the best financial situation when you walk away from that closing table.